Good afternoon, everyone. Today is Wednesday, November 6, 2013. My name is Michael Comeau, and I would like to welcome you to our exclusive interview with Jeff Cooper, who is the author of Minyanville's Daily Market Report. Jeff has been a successful trader and technical analyst for over 3 decades. He started out in the investment bank Drexel Burnham before moving on to a hedge fund and then striking out on his own. Just as an FYI, this call will be recorded. We will send you a replay. So you don't have to worry about emailing us or anything. We will send it to you. So without further ado, I'd like to thank Jeff for joining us. Jeff, how are you?
How are you today, Mike? Thanks.
I'm doing great. Just as a reminder, audience, you are free to enter questions if you'd like. So Jeff, why don't you tell us a little bit about how you first got interested in trading?
Well, my dad had been in the markets for many years, and I'd been in the skateboard business. I was actually one of the originators of Dogtown skates, and had a skate store and manufactured them and sold them all over the world. And the business just dried up about 1980, and went to work for my dad, who was a big new issues guy. And I knew nothing about the market, and basically he taught me the ropes and how to read the tape, and my job essentially starting out was going out there and trying to find hot IPOs. And I remember, contacting as many brokers as I could, looking for shares of Apple, which came public at that time, and Genentech. Those were the two big hot deals as I was getting into the game.
Okay, so would you say that from the start you were mostly a technical guy?
No, I knew nothing about technical at all. I was literally just following my dad's lead, and I wasn't trading then at all. I was just getting IPOs and doing secondaries. And I realized my dad had no knowledge of didn't know what a chart was. I mean, you could have showed it upside down. It wouldn't have meant anything to him. But I was getting interest in the market and wanted to get a foundation in it, and eventually found an extension class at UCLA, and that was really that was the the inception of really a big interest and fascination with the markets, because the guy that taught it was the president of Drexel, and he was a real Renaissance man, and he would quote Shakespeare and Milton in references to the market and crowd behavior historically, and eventually it led to, he suggested that I apply for a position at Drexel, which I did, and because the IPO business had dried up for a few years after 1980 into 82, and so I went to work for Drexel, and stayed there for less than a year. I really didn't like the dialing for dollars. They weren't interested in how much one knew about the market, or how much really one wanted to learn about it. They were really interested in just how much you could sell.
Okay, so what was it like transitioning to trading for yourself? How did you get started, and how challenging was it?
I stayed with my dad until just after 1987, and during that time I started trading for myself. And every Saturday I used to go to Daily Graphs, which was in West LA, to pick up the chart books. And they used to have a small bookstore there. And one day I walked in and found they had discontinued selling any books, and asked them to if they could recommend any place where I could go. I was interested in reading as much as I could at the time about the market, and they recommended a small bookshop that was upstairs of an auto mechanic place in West LA. It was really a dingy little place, and just around that time, a broker that I was dealing with had asked me if I had ever heard of W.D. Gann and stocks squaring out, and I had never. I had no idea what it meant, and I said, "Tell me what's the implication? What does it mean?" And his idea at the time was, well, 6 times 6, which is 36. That should be a natural. For example, that should be a natural support or resistance level for stocks. So this is something that was completely out of left field for me at the time. So anyway, I go upstairs to this bookshop and was looking for something to read about W.D. Gann. And there were two guys there that were partners, and I asked one of them if they knew anything about W.D. Gann, and they laughed. And the one guy proceeds to tell me that his partner was the foremost expert of Gann in the United States, and he gave a series of courses of lectures about Gann, and they weren't cheap. It was about $500 a lecture. There were 12 of them, and so I enrolled and took about 6 of them. He passed away in the middle of the series, so I was never able to complete it. I would say that the lectures were probably created more questions in my mind than they answered, but it did definitely give me an introduction to, to the more esoteric side of the market, and began a real interest in research that still continues.
Okay, I'm glad you brought up Gann theory, because you're known for sort of using these unconventional tactics like Gann theory and the square 9 chart. Now, how do you balance those types of things with, I guess, more traditional technical analysis concepts? I mean, a lot of people look at moving averages and trend lines, and do you like to mix the two, or is it strictly Gann theory for you?
No, I like to mix the two. Gann used to say, use all the tools all the time, which is easy to say, but in my experience, it's not really practical, because you can become overwhelmed and paralyzed, and it's hard to make a decision. At the same time, the more clusters of indicators, whether it be Gann methods or Elliott or, as you say, the plain vanilla techniques that come together, usually will create, usually present a situation where the odds are more in your favor. So I don't really find it, a disconnect. It's all roads lead to Rome, essentially. If all methods, all techniques should point to the same resolution.
So is it fair to say that there's no best way? It's just everybody kind of has to make their own path?
Well, I can only say what works for me. I start by looking at the plain vanilla, moving averages, trend line, and pattern. I really key off pattern more than anything. And actually, we've got I came across a quote here from W.D. Gann that's worth repeating. And it's this: 85% of what any of us learn is from what we see. It has been well said that one good picture is worth 1,000 words. That is why form reading, which is what Gann referred to as pattern analysis, or the reading of valuable formations at different periods of time, is so valuable. The future is but a repetition of the past. The same formations at tops or bottoms or intermediate points at different times indicates the trend of the market. Therefore, when you see the same picture of formation in the market the second and third time, you know what it means and can determine the trend. So when I started out, somebody had mentioned to me, and it might have been, I think actually it was Ed Sekoto, who I met, the famous futures trader, who I met in 1990, suggested taking, what he had done is taking a 3x5 index card and taking it across a chart book, which is what I did at the time, or now a computer screen that you have a chart on, and just covering up the future action and dragging it across. And it was a good exercise, because it was amazing to me how many times that I would guess wrong about which way the trend would go and what the next direction was. So that I recommend that. It's a very good exercise. But for me, I key off pattern, and then I'll go to the Gann stuff. If it looks like there's something there in the pattern of the stock, then I'll drill down and look at the square 9 wheel and the 3-day chart, the weeklies and the monthlies, et cetera, et cetera. So I typically start with the plain vanilla first.
Okay, why don't we step back a little bit and kind of reference a little conversation we had offline. Now, I mean, I've heard a lot of technical analysts say that They never look at news. They don't pay attention to earnings or fundamentals or things like that. They're strictly keying off price. Like, how do you fit? I mean, do you subscribe to that? Is all your work based on, I guess, patterns?
Pretty much. I think that price is the final arbiter. It's the point of the sword, and it'll tell you where we're wrong, which is much more important. It's very easy to get into trouble in the market. The hard thing is the hard thing is to manage the risk and to know when to get out. I think there's much too much emphasis on trying to find the ideal entry strategy, the holy grail, when really the emphasis should be on managing the trade once you're in it, and getting out is, to me, for me anyway, it's much more of an art than a science.
Okay, since we're on the, I brought up the Fed. A lot of people say that algorithms and quantitative trading and program trading are dominating the action. Do you actually see anything in, maybe there's different patterns that used to work that don't work anymore, that, I mean, do you see any actual distortion in the market action that might make it more difficult to analyze it?
I think it is much more frustrating, and I think there are many more, it feels to me anyway, like there are many more fake outs and breakouts than there used to be, and that's probably a function of the, what they call the black pools and the hide the salami games that go on with these hidden pools and the bids and offers that are it's show and pull. So I grew up being a tape reader, and that's really, I think, much more difficult today. That said, I think what doesn't change is the human emotions and patterns that backstop, ultimately the backstop of how the market plays out. But I think that the moves can get intraday and over the long haul can get exaggerated by virtue of the algos and the HFT, also by what the Fed is doing. That said, even in that may sound like an excuse to many people who are, doing very well in this market. A lot of fund managers that are doing very well, just riding the trend. But at the same time, there was manipulation. There's always been manipulation. There were the pools and the hidden interest in the 4 or 5 years going up to the top in 29 as well. So you can always make excuses, but we've got to trade the market that is, not what we'd like it to be. And the other part of that equation, I think, is, for example, I've been intellectually bearish in the market on and off for many times during the last few years, but you've got to kind of put that intellectual bearishness based on what you may or may not think the Fed is doing on the sidecar and trade what is going on intraday or on swing positions, and not let that really color what you think what you think of the market, what your opinion is of the market. That's just going to keep you out of the game.
Okay, glad you brought that up. I think everyone kind of agrees that it's harder than it used to be, but was it ever easy? I mean, you've been watching the markets for 3 decades now. Has there ever been a time where trading was actually easy?
I think there was a time, 1998, 99 into 2000, where it was so easy, and again, this was before decimalisation, and it was very easy to read a tape. When a stock, you could look at level 2, and you could see the size offers pile up on the bid or offer side, and typically most stocks were trading in eighths. And so when a stock went on the move, when it went on the prowl, there would almost automatically, because there was so much momentum behind the market at the time, there would almost automatically be a 3/8 to a half-point move quickly. And if you're trading 2,000 shares of stock, you get enough 3/8 to 1/2 point moves intraday enough times, it adds up very quickly. So that was, and it was really scaring me at the time because it was almost like a free lunch. I remember one morning going upstairs about 40 minutes after the market had opened, and my wife said to me, "Aren't you working today?" And I said, "Well, yeah, but I made X amount, and I'm afraid to go back downstairs in front of the computer because I don't want to give it back." But that was a time where it seemed so silly that it did feel like a free lunch, but it continued for a period. You know, we're all in this generation, the generation before, you know, that came after me. I think we're all children of immediate gratification. This is the culture that we're in, and you know, we're looking for. We see setups. We think the market is overbought. We think that it's a bubble, but it goes on and on, longer than we ever think it could. It takes time for things to play out. It takes time for tops to build.
Okay. You talked earlier about how exiting a position is more of an art than the entry. So how do you handle that situation from an emotional standpoint? Or are you strict? There's an entry and an exit point, and that's it.
I'm strict when it comes to stops and adhering to stops, and putting a stop in, a mental stop in, before I get into the trade, rather than during the trade. Once you're in a trade, you know, you get into a trade and say, okay, I'm going to watch it, and I'll stop myself out. My experience, that can be the kiss of death. You've got to decide where your uncle point is, and then have a fail-safe beyond that if you don't adhere to the initial stop or uncle point before you get into the trade. So that is what I'm good at. What has been difficult for me throughout my career, because of a personal, my own personality perhaps, and because I saw my father go broke in '62, and although he came back and made back more than he lost in the market, still, you know, I was a teenager when that happened, and growing up, I think I had a healthy bit of skepticism and cynicism about the market. And so it's been difficult. It's been something I've had to fight in letting a position run and getting out too quickly rather than letting the market take me out. And that's something that I still struggle with.
Oh, okay. Glad you brought that up. So, you know, as I referenced, you've been in the market for a long time. So what's kept you trading for so long? I mean, do you love trading, or is it just a job?
No, I wouldn't. I don't think I would still be in it today if I didn't have a passion for it. What's interesting, what's fascinating and interesting about the market is that it's different every day, yet it's the same every day. So you have the same basic framework which you're going to trade from, yet the market throws your curveballs every single day. So that's what makes it fascinating. What drives the market? What makes it work? I think it's, for me, I think it's the psychology that that interests me, and in how the pieces fit together.
Okay. Now you use a lot of, I guess, sort of proprietary strategies. Like you have the Soup Nazi setup, the Holy Grail buy setup. I guess, how do you get turned on to these particular strategies, and how do you decide whether they work or not, whether there's something you can rely on?
Well, as I mentioned before, I glommed on to, and I had the same belief before coming across this Gann quote many years ago that I mentioned, but I've always believed we think in images, and I've always been interested in patterns and images. I took up photography as a teenager, and then going to NYU, I majored in film and economics with a minor in literature. However, I was always more drawn to the idea of still images in photography, being able to crystallize the essence of something as opposed to film, which tells a story. Likewise, in high school, I started writing poetry, which again attempts to capture the essence of something and crystallize a thought. So I think about it this way. Photography is to poetry as film is to a novel. So my thing is the particular patterns in the market cycle through at certain periods, and I like to think of the market as a series of still photographs that slip together like an old kinescope to form a fluid picture or film. So I don't remember what your initial question was actually, but that's you know, that's just something that that I glom onto the market in that manner.
Oh, okay, I think it's interesting you brought up that kind of varied backgrounds as you have an interest in the arts. Um, and I guess that speaks to your personality. Now, do you think some people, I guess, have an innate ability for trading? I mean, you talked about pattern recognition. I mean, do you think there are people that, at least in terms of technical analysis, just automatically have a good feel for it strictly because of, I guess, visual recognition and things like that?
I think that there are two qualities that successful traders, two disparate qualities that they really have to bring together. One is a real discipline, as I said before, in being able to honor, adhere to stops, to be able to manage risk. And the other is to be able to use that intuitive sense. For example, George Soros says that he is the reason he is rich is because he knows when he's wrong, and he's on record as saying often he'll be sitting at a screen and have a position on, and his back will start to hurt, and he knows that he's in the wrong position, and so I think it's for me, I think it's trying to merge and combine the right and left brain areas of the market. I mean, I approach the market from a stock tops-down basis, not from a macro bottoms-up basis whatsoever. I mean, although I took economics in college, accounting is which is what I thought the market was about. You know, when I watched my dad operate. Before I got into it, I thought it was very dry, and so my path in the market has basically been kind of a merger of this, you know, blending of this right and left brain experience, and I think that's what's fascinating about it for me anyway.
Okay, I'd like to remind the audience that we are accepting questions, so if you have one, feel free to just type it in the chat section. Okay, so do you engage in any kind of long-term investing? I mean, do you have like retirement accounts with mutual funds or anything, or are you strictly a short-term trader?
When my daughter was born about 10 years ago, I started a dollar cost averaging account and a mutual fund for her, as well as a SPY account. And it was only a few years ago that I started to do the same for myself. And I wish I'd done it much earlier, because I think that is one of the true ways to invest in the market, to be able to beat the market. It's when I was a trader in the 90s, I was a gunslinger and I was a tape reader, and I shot at anything that moved. Now, and it was a great distraction. It was profitable and it was a great distraction. I don't think that same environment is there today because of the decimalisation, which they say was in order to, you know, to create a more level playing field for the retail investor. I think the truth is that it was created to enable the HFTs for whatever purposes, but to me, less is more today. In other words, I try to rifle shot now in trading, as opposed to, you know, spraying with a staccato machine gun-like approach.
So, so is that just a factor of there being less tradable opportunities because of decimalization?
I don't know if it's less tradable. I think that things are so so fast, and I think the way to look at it is like this. Prior to decimalisation, you could read the tape as if watching the wings of an eagle. Now, it's like trying to watch a hummingbird, the wings on a hummingbird, and that's hard for the human eye to decipher. So let me put it that way. I don't know that there are less opportunities, but I think they're more difficult to decipher, and there's more games.
Okay, so if you met someone that was interested in getting started trading, assuming very, very little financial experience, like what advice would you give to a person like that?
I would say that always have a game plan and adhere to it as much as you can, which means adhering to a stop and setting that stop before you get into a position. I would say when you're in doubt, get out. And when you're on a losing streak, which we're all going to get on, get smaller, not larger. It's lethal to try to get larger and add to a losing position, which is the natural emotional inclination in order to try to get even. Getting even is lethal. Trying to get even is lethal. I would also say start every day as if you're at zero, whether you've got overnight positions or not. In other words, don't let big unrealized gains or a buildup in your capital dictate a different composure, a different complexion in your attitude. Just because you've made a lot of money, don't get cocky is another way of saying it. And I would say pat yourself on the back for taking small losses. This keeps your emotional and financial powder dry for the nice opportunities that will come along, and they will.
Okay, on the flip side, at Minyanville, in our discussions with individual investors, a lot of people are extremely frustrated with the market. I mean, we get the sense that a lot of people sort of, they nailed the economics, they nailed the fundamentals, but they were wrong in the market because we see mediocre economic data. We've had a few lousy earnings seasons, and the market's gotten ramped up. It just has basically ramped straight up. So, I mean, what would you tell somebody that's experienced but just very frustrated at not being able to handle things?
I think about, generally the state of the market as it is now, and seeing that there seems to be, or that there is, a huge divergence between what's going on Wall Street and Main Street. And in thinking about that, I look back to and try to imagine what many people might have thought in the early days of World War II, when things looked dire in the world, and it looked like a maniac was going to dominate Europe or was dominating Europe. And yet the stock market made a major low in 1942 and continued higher, eventually, taking out the 1929 high in 1954. In the short run, I would say that I'm frustrated with the markets every day. I think it's just something that comes with the territory. It's a great arena for banging your head against the wall and reenacting things in our personal lives that we may be struggling with without even knowing it. That's one of the things that I've come to learn about the market, that it's also a terrific arena where one for self-discovery, where one can learn about themselves. Generally, I would say the market is it's a place where you've got to learn to suspend disbelief, and that's what's going on now. You've got to learn to divorce an intellectual opinion about what the market, about what you think about the market with what it's doing. You've got to decide if you want to be right or you want to make money. So there's this kind of natural, enigmatic quality to being successful in trading, I think. You make money when you're right, presumably, but that often entails doing what goes against the grain of what you think and feel.
Okay, now we're getting some very, very interesting questions from the audience. In fact, they're way interesting than what I had planned. So, here's a good one. What are a couple of aha moments in your trading career? And I'll translate that as, can you tell us about, I guess, a big winning moment for you and a big losing moment?
Well, one of the biggest losing moments had to do with the trade that my dad and I had on uh, in the late 80s. He was very close to a broker at the time at Montgomery Securities, and they were very bearish on a company called Commodore Computer at the time that was trading about 45, and they thought there was a lot of, how can I say, there was a lot of padding of their sales, and their earnings were going to miss. And the thing about my dad was that he liked to go all in. And so he took a very large short position, and we cleared through Bear Stearns at the time. We DVP'd through Bear Stearns, delivery versus payment through Bear Stearns. And so I think we had the position on about a week, and the stock just, stayed in a pretty narrow trading band. And the earnings were still about a month, 6 weeks away. And we got a call from Bear Stearns that the stock was no longer borrowable. And so we couldn't, we had a cover, we couldn't borrow it anymore. And about 2 weeks later, and during that time, just before we got that call, the stock had run 10 points from about 45 to 55. And then my dad gets the call, we get the call that we can't loan it out anymore, it's not borrowable. And so we have to cover. If I knew then what I know today about the street, I would have gone out and tried to find another place to borrow it. Within a matter of a few weeks, Commodore began to decline, and ultimately, within a month, was at $10. So that was it was a huge hit. It was a big hit. My dad was quite short, and that taught me a lot about the street. And it's interesting that you want to ask yourselves why certain, Ace Greenberg, who ran Bear Stearns, was a great card player. So you got to wonder. I'm not casting any aspersions on Ace, but you've got to wonder why someone would want to, why potentially someone would want to have a clearing operation where you get to look at everybody's cards, don't you? So the stock was called back from my dad to loan out to someone else. So that was an experience that taught me a lot about, how the street worked and the inner workings. That was something that that obviously I still still hits home. And I would say there's no one particular big winning trade that I remember. I would just say that period during 1999, when it was basically the conceptually correct stance was buy market on open, sell market on close, and you made a lot.
Okay. So what's a typical trading day like for you? Do you have a specific process you follow every day?
Yeah, that process starts with putting together the nightly trading report and screening a handful of stocks. Basically, I have a universe of stocks of maybe 40, 50 stocks, and within that, a smaller nucleus that I follow intraday very carefully. So that smaller body of stocks, I'm trying to get a feel for the relative strength against their peer group intraday, against what the futures are doing, just to try to see if there's, if there's waves of buying and selling. And so what I want to do is try to have a half a dozen stocks or so that I think are set up to move in both directions, typically, the next session. And again, as I mentioned earlier, probably the hardest thing for me to overcome is not having a lot of patience. The one thing that I wish I did more often than not was not trade the first half hour and wait for what I call an opening range breakout, either to the upside or downside, a move either above the first 30 minutes high or below the first 30 minutes low. And I think that would be probably be much more rewarding. That said, when the stock triggers by taking out a prior day's high or low, even if it's within that first 30 minutes framework, I'm going to be in the trade. So that's it's setting up. It's having the setups that you're looking to trade and narrowing them down to something that you can watch, to a number of stocks that you can watch for the bell.
Okay. Do you ever trade options?
I used to trade them much more than I do now. Now, very, very infrequently. If I do an option trade once a month, that's probably typical.
Okay. Now, do you just trade individual stocks? Do you trade futures or ETFs or currencies or anything else?
I never trade futures. When I got into the business, I started, strangely enough, trading futures, and it's an interesting story, a quick story. This was in 1982, and I'd inherited some money from my mother that had passed away, and I put them in bonds, which were yielding very high rates after Volcker, or during the Volcker period, and the bonds were going to be maturing in the spring of spring of 1983. And so I walk into a Shearson brokerage office, and what I was looking to do was to buy 30-year bond futures in order to take delivery for when my bonds matured. So I wanted to lock in these rates. Anyway, I got involved with the largest broker in the office at the time, an Iranian guy, a great guy, and he had 4 or 5 of his friends that were very wealthy individuals, and they were trading futures like crazy. So rather than do the bond situation that I had gone in there to do and to protect the yield that I was getting, I got interested in the S&P futures, which had just started, I think, within a year prior to that, and this was early August 1982. I had been hired by Drexel and was going to be starting there in September, so I had a month basically just to kill some time. So I would go into the office every day, this guy's office, and eventually I opened an account and bought some futures, S&P futures, and I made $20,000 in the first few days. That was a lot of money, especially in those times, especially for me. And made $10,000 the next week. And at the time, I was taking the only technical service I was taking. The only one I had heard of at the time was Stan Weinstein, professional tape reader. And I remember calling the hotline that Friday night. The Dow had run up from around 780 to 830, and that's how I had made the money. And I remember Stan saying, I think the market could have a little pullback here, but he was very bullish, but nothing to get excited about. I had no idea what I was doing. I had no idea the kind of drawdown I could have based on the leverage of the futures. So not only did I get wiped out of the $30,000 profit, but I got a margin call for $20,000. So, and I think that was probably the best experience I could have had, because if my first experience in the futures markets had been profitable, I think it could have led to a problem. I think that was a great learning experience.
Okay. So is there any kind of source materials or books or any other educational things you'd recommend to learn about Gann theory?
I would read, many people that are interested in stocks dismiss how to make profits in commodities, but the word profit is the word stock is, the word how to make profits in commodities, the word commodities is a misnomer. It applies as much to stocks as it does to commodities. I would read that and The Truth of the Stock Tape, and I would definitely read those two. The Gann courses are very complex, and you can get overwhelmed. I would start with those books. I think the Gann courses, he was trying to sell things during his time, and I think he loaded up a lot, and he gave a lot more information that was necessary, and he had a way of being very obtuse when he wanted to be clear, and very clear when he wanted to be obtuse. So it was kind of a shell game with what he was trying to relay to his students, and I think part of that may be because he was trying to sell courses. But nevertheless, I would read those two books. For anybody that hasn't read any Gann, I would start with those two books.
Okay. So before you talked about watching the first 30 minutes trading for the opening range breakouts, do you think that's the start of trading is sort of amateur hour, where people are just, I guess, kind of sending in market orders? I mean, do you specifically avoid that period?
I think there can be a lot. I think there can be a lot of painting in the tape, and I think put yourself in an institution's shoes. They may have a genuine interest in buying something, but they don't need to chase it from the get-go. You know, they may put their toe in the water. They may start something. So initially, what you see a lot is a stock run up, and an institution will chase it to a point. And so you have in the first, 10, 15 minutes what I call opening whiplash. In other words, the stock will run up, come back and test the lows, maybe undercut them marginally, and then start to trend. So that's a pattern that I think you see a lot. So I don't know that it's amateur hour, but there's just more whippiness.
Okay. So is there anything you do after the trading day to kind of unwind and loosen up a little bit?
Well, I've started going to the gym again in the last 6 months, which I had just stayed away from for about a year and a half, which helps tremendously.
So do you think it's important to have...
Very stressful game. Excuse me?
I was going to ask, so would you regard physical health as something important for a trader?
Yeah, I notice a completely different composure in my own mindset since I've started going to the gym again, frankly. It's a very stressful game, and I think it's important to relieve that stress. I think the mind-body connection plays a definite role in any success you're going to have as a trader. And I've noticed that that release has been beneficial.
Okay, now we have a very fascinating question. Would you ever play poker with Ben Bernanke? And if so, would you win?
I have no idea. I think if he spoke a lot, it might be helpful because there tends to be this quiver in his voice. So you may get an idea if he's holding pocket aces.
That's a good one. Okay, so we are winding down, so we will give you the final question, which is, seems like it's what on everybody's mind. Do you feel like we're on the verge of a big plunge and that we're just propped up by the Fed? We sort of talked about this a little bit, but we'll make this the final word.
It's funny. I'll make this quick, but there is an old-timer, well-known letter writer out there who I do respect, and but I remember, and I read him from time to time, and I remember I think it was June of 2007, he had been bearish, and in June of 2007, he wrote that he thought the market was on the threshold of a third great speculative run. And I was quite bearish at the time, and the thought went across my mind that he's capitulating. We must be getting close. And of course, the market sold off from a July peak, a primary peak in July that year, sharp shakeout into August, and then once everybody had bought the protection and hedged, they got squeezed up into October, and then the plug was pulled in January of '08. And again, I recently read that this guy's saying the same thing. After being bearish for some time, we're going to have a third great speculative binge. I don't know. I look at the market and I see we had a great speculative binge going to 2001 into '07, and that we've been in a third one, and potentially it's formed a huge 13-year megaphone top. They talk about the NASDAQ making a 13-year high, and I look at 1987 plus 13 years, giving you 2000 and 2000 plus 13 years, giving 2013. So I don't know if we're going to have a great plunge. I think it's possible. I just don't think that what the Fed is doing and the market's response to it is ending well. And I think a lot of people, a lot of money managers that are in the game think that they'll be able to recognize and get out of the party in time. But that's always the case. That's always what people think going into a bubble. And at the same time, you've got to say that big bubbles start with small bubbles, and so you never know. You know, you look at any school kid's face that's been chewing bubbles and its face is splattered with bubble gum. You don't know where that point is. It's hard to. It's all relative. What's a small bubble and what's a big bubble? So my own personal belief that it doesn't end well, and that I think we are at a turning point here. Whether that means it's the 1770 level, or whether it means we have another last-ditch run into the low 1800s, I don't know. The other side of that coin is that the market isn't going down. The 60-year cycle suggests that we have another couple of years up, a la 1954, when the Dow finally eclipsed the 29 high, so 1954, 55, 56. So that's the other side of the coin, that we do the Weimar thing, and the dollar gets more depreciated, and the means to production, in other words, corporations, are bid up. So I think we are at an important inflection point, and it's going to be interesting to see which way this thing goes.
Okay, that will wrap us up. Ladies and gentlemen, if we did not get to your question, we apologize, but if you'd like Jeff to answer it, you can send them to Cooper@Minyanville.com. That's COOPER at MINYANVILLE.com. I can't believe I actually spelled that right. But again, we will send you a replay, so you don't have to worry about emailing us or anything. And Jeff, thank you very much for your time. This was great.
Thanks a lot, Mike.